Hello friends, I have prepared this video for Certified Treasury Professional exam conducted by Indian Institute of Banking and Finance. In this video, I will take you through chapter 6 of the textbook which is prescribed by IIBF, and it is called as Treasury Management. This book is available on Amazon. This is a book which is which is an essential requirement to prepare for this exam, which is Certified Treasury Professional. I am going to take you through some concepts of chapter 6, which I am sure will help you to prepare for the exam. This chapter is very extensive, so making one video on the entire chapter is not going to be helpful. So I'm going to have two videos. This is the first one. So what is it that I plan to cover in this video? So you will get to know about call, term and notice money market, certificate of deposits and repos. Okay, so these are the three things that I'm going to cover one by one, and I will give you all the possible details which will help you to prepare for exam also. Right, so let us start by looking at call money, notice money and term money. So these are three components of the money market uh, where borrowing and lending of money happens. Okay, so what is being borrowed and lent here is nothing but money which moves through bank account. But before I talk about that, let me tell you that call money market is borrowing and lending in unsecured funds on overnight basis. So call money market is also called as overnight market. So you are just borrowing for one day. So if you borrow on Monday, the money has to be returned on Tuesday. That is the call money. Then you have notice money, which means borrowing or lending in unsecured funds for tenure up to and inclusive of 14 days, excluding overnight borrowing or lending. So what does this mean? This simply means that here you are going to borrow or lend for more than 1 days up to 14 days. That is what is the notice money market, which is the second segment. So call is for 1 day or overnight is for 1 day. Notice is from 1 to 14 days, and term money means here you are borrowing for more than 14 days, which is 15 days up to 365 days. So this is how the market is segmented into three different buckets. Let us move further and look at what are the features of call money, term money and notice money market, which is what I will take you through here. So this market, as I have already told you, is an unsecured market. So there is no collateral backing it. Repo is a secured borrowing because in repo transactions you have collateral, but here there is no collateral. So this is a market without collateral, and hence only limited players are allowed to participate in this market. In my subsequent slides, I will show you who are the players who are allowed to participate here. Trading happens on NDS call segment of CCIL. So there is a specific segment called as NDS call on which this particular trading will happen. The trading may also happen outside the platform, but it has to be reported. That is something which we'll touch upon going forward. The day count convention which is followed here is actual by 365. Since call money is a money market instrument, including notice and term, so RBI guidelines very clearly say that whenever interest has to be computed, the period that needs to be followed is actual by 365. That is what I have mentioned. This overnight call money data is used for computing MIBOR or Mumbai Interbank Outright Rate. That is what gets calculated through call money data. The rate on overnight market indicates trend in the interest rate in short term. So this is a very important market, not just from the perspective of borrowing and lending, but this market also indicates how are interest rates going to trend. WACR or weighted average call rate is monitored by RBI and other market participants. So this is, as I said, it's a trend indicator. So WACR is a very important component to look at where are the rates moving. Banks borrow in overnight market to meet short-term liquidity requirements. So most of the borrowing happens for one day. However, in some cases the borrowing may get extended slightly, maybe for 3-4 days and mostly up to 14-15 days. You will not see many borrowings happening for 100 days or 80 days or 70 days. So effectively the utility of the market is more in terms of overnight market. it is not a discounted instrument. So this is very clear. Like treasury bill is a discounted instrument. This is not a discounted instrument. So here when you borrow and lend, what will happen is you will borrow an X amount and you will return that amount, which is principal amount plus the interest, which you have to pay for a specific number of days. And the settlement in this market happens on T+0 basis, which means the day on which you trade, you receive money in your account, and next day you return the money back. Now, who can participate? As I said, it's an unsecured market. So RBI has put a restriction on who all can borrow and lend in this market. And there are only 6 distinct entities which are allowed. So scheduled commercial banks, payment banks, small finance banks, regional rural banks. They were allowed during COVID time by RBI. State cooperative banks, district central cooperative banks, and urban cooperative banks are allowed. Primary dealers can also participate. Primary dealers may require fund from time to time, especially the standalone primary dealers, because they don't have any source of deposit. So for them, this market is open for borrowing. Now there is a prudential limit which has been set on borrowing, which means for every type of borrower there is a limit up to which they can borrow. Right? You cannot borrow unlimited from call money. So what is the limit? If you are a scheduled commercial bank, then there has to be an internally approved, prudential limit for interbank liabilities prescribed by Department of Regulation of RBI. Right. So basically, for, as I said, for different segments, you have the prudential limits under which you can, borrow and lend, and that's something which is very clearly mentioned as part of the master direction of RBI of 2021, right? So that's when the RBI came out with the master direction. If you are a small finance bank, then what is the transaction that you can do, which is also mentioned here, right? For payment banks, again it is said that 100% of capital fund on a daily average basis in a reporting fortnight. Cooperative banks will do similarly as a part of a percentage of aggregate deposits, okay, and same logic, which means a threshold is also applicable for primary dealers. What can they do? So 225% of net owned funds, as at the end of the previous financial year on a daily average basis in a reporting fortnight, is what they can borrow. So basically the idea behind this particular slide or this particular norm is to let you know that there is a restriction up to which the borrowing and lending can be done in call money market, right? Having said that, please note that interest rates in call, notice and term money are market determined. What does that mean? That simply means that there's nobody fixing the rate here, nobody deciding the rate here, but the supply and the demand condition decides the rate in this market. Call, notice and term money transactions shall be executed in over the counter markets, where they can be done, okay, including on NDS call platform or any electronic trading platform which is authorized by the RBI. There is a timing which is fixed, 9 AM to 5 PM, which is where the trading happens, and eligible participants shall follow the standard market practices, methodology and documentation prescribed by FIMDA in consultation with RBI from time to time. So these are the general guidelines for transactions in call, term and notice money market. Now we have just discussed about money market, first component of money market, which is your call, term and notice money market. Now we are moving on to the second instrument, which is called a certificate of deposits. Okay, so what is a certificate of deposit? It's a negotiable, which means it can be transacted between parties, unsecured money market instrument issued by a bank as a usance promissory note, okay, against funds deposited at the bank for a maturity period up to 1 year. So that's the concept of certificate of deposits. And certificate of deposits may be issued by scheduled commercial banks, regional rural banks, small finance bank and all India financial institution. But in this video we are not covering the guidelines which are applicable to AIFIs or all India financial institutions, right? It is only for scheduled commercial banks, regional rural banks and small finance bank that will touch upon the details in this video. So let us move to the next concept, which is where we will see what happens with respect to the certificate of deposit. So details of primary issuance of a CD shall be reported by the issuer to the trade repository, which is managed by CCIL. So there is a requirement that whatever is issued must be reported, because they will be issued not on an exchange but typically in kind of a OTC market, right? So FTRAC is the platform, which is Financial Market Reporting and Confirmation Platform. That is what it is called as. If there is any transaction which is happening in OTC market, which is secondary market, not the primary market, that also will be reported on FTRAC within 15 minutes of execution, and details of buyback will also be notified on the FTRAC, right? So this is something which is a requirement as far as the certificate of deposits are concerned. CDs shall be issued only in dematerialized form and held with a depository. So that is a requirement, and this depository obviously has to be registered with SEBI. CDs shall be issued with a minimum denomination of 5 lakhs and in multiple of 5 lakhs after that. That is the requirement in terms of its denomination, and its tenure shall not be less than 7 days and shall not exceed 1 year. This is only for banks that I am talking about, nor not about AIFIs. CD shall be issued on T+1 basis, where T represents the date of closure of the offer period for issuance of CD. That is what is the settlement cycle that you will see for the CDs. Okay. CDs may be issued at a discount to the face value. CDs may also be issued on a fixed floating basis, provided the interest on floating rate CD is reset at periodic rest agreed to at the time of issue and is linked to benchmark published by and approved by FIMDA for this purpose. So basically it's very clear that it can be fixed on a discount basis with a coupon also, right? And FIMDA shall ensure that any floating rate approved by them for this purpose is determined transparently, objectively, and in arm's length transaction. That is what is the expectation as per RBI circular. Now CDs can be traded OTC, including the electronic trading platform, or on recognized stock exchange. So both the places it can be traded. Settlement cycle of OTC CDs shall be T+1 or T+0. All secondary market transactions in CDs shall be settled on a DVP basis through the clearing corporation of any recognized stock exchange or any other mechanism which has been approved by RBI. So that is the broad requirement with respect to the CDs. Okay, so this is what we need to know about CDs. Having said that, there is a buyback of CD which is allowed. So buyback has to fulfill certain conditions which have been listed in this particular slide. But buyback of CD can be made only 7 days after the date of issue of CD. So you cannot buy back the next day for sure. The buyback offer shall be made to investors in a particular CD issue on identical terms and conditions. The investor shall have the option to accept or reject the buyback offer. So it is voluntary. Buyback of CD shall be at the prevailing market price, and CDs bought back partially or fully shall be extinguished. This, the point to be noted here is that CDs are a deposit, so the bank issuing CD will have to maintain CRR and SLR on these deposits, right? So we have covered two things: call term notice money market, and now we are coming after that we covered the certificate deposit, and now we are coming to repo. Okay, so repo is also a money market instrument which enables collateralized short-term borrowing and lending. So please remember that repo is a collateralized borrowing and lending, which is unlike call money, which is without collateral. Okay, under a repo transaction, a holder of securities sells them to investor with an agreement to purchase them at a predetermined. So that is the typical definition of repo. Of course, in all repo transactions, securities are not sold. We will discuss that at a later stage. Okay. In case of a repo, the forward clean price of bonds is set at advance at a level which is different from the spot clean price. So basically the difference in the price of two instruments, same instrument at two intervals will decide what is the interest that you are going to earn. Okay, so this is how the settlement which is done. So the statement says that in case of a repo, the forward clean price of the bonds is set in advance at a level which is different from the spot clean price by adjusting the difference between repo interest and coupon earned on the security, right? So this is how the concept of repo will work. You are adding two components. One, which is the repo interest, and second is the coupon of the security on which repo has been done. Okay, so what are the types of repos that you will see in India? So India has one repo that happens between RBI and banks, and that is under LAF, which is liquidity adjustment facility. That's a repo which is done by RBI basis the requirement which the market may have. So repo is no more a daily repo. It is a repo which happens on the requirement basis or on the need basis, right? That's very clear. So whenever there is a repo transaction being done, RBI will pre-notify when it wants to do the repo, right? And it will conduct an auction. It is called as the variable rate repo and variable rate reverse repo, VRR and VRRR. That is what it is called as. But beyond that, you can also do repo. There is a market repo which can be done on Chrome's platform of CCIL. So CCIL has a Chrome's platform on which two types of repos are done: basket and special repo. Okay. You can also do TREPs. In TREPs, there are three parties: the borrower, the lender, and a tri-party agent, which is also something which is available on CCIL's platform in India. RBI in the past has done long-term repo also. 3-year repo RBI has done, 1-year repo it has done. So typically repo is a money market instrument, but in some exceptional cases, regulators of the country conduct what you call as long-term repo. Right, so you have the LTRO and TLTRO, and then you also have CB repo. CB repo is nothing but the corporate bond repo. In this kind of a repo, we have underlying as what is called as the corporate bonds. So as I told you, when the repo transaction is being done, okay, you will see that the repo transaction typically flows like this. So here is the security on which repo is being done, which we can see here very clearly. So this is the security on which the repo is being conducted. That is the point that we need to know. There is a coupon payment date, which is 15th January and 15th July. This is the price of the security on which repo is being done, and this is the date of repo. So once the repo is being done, from the last coupon date to the date of repo, okay, there is a need to calculate what is called as the accrued interest, and that is what gets calculated in case of a repo transaction. So you can see that there is a there is an accrued interest which is getting calculated, 8.07 into 73. 73 is nothing but the difference in the days. So this 8.07 is this coupon. This is the last coupon date that you take, and this is the next coupon date this is the settlement or the date of repo that you take. So the difference between 15th January and 20th March is 73, and then it is divided by 360. Why it is divided by 360? Because this security is a government security, and day count convention for government security is 30 by 360 in India, right? For money market, it's actual by 360, but for government securities, it is 30 by 360. So what I said, you first take the coupon, then apply 73 upon 360, which is 15th January to 20th March, that is 73 days divided by 360, and you find out the accrued interest. So accrued interest is 1.63 here. This accrued interest is added to the market price of the security, and then you reach here. So after that, what you do is that you add to this the repo interest. So the repo interest will be calculated for 5 days because repo is for 5 days. So on this 103 rupees 20 paise, okay, 5 days repo is calculated at 9%, and this is the amount which is found, right? So the price of the second leg happens to be 103.33. The first leg price was, which we already know, which was 103.2064. So this is how the price is set, which is what we spoke earlier when I introduced you to the concept of repo, right? So as I said earlier, in India we have LAF as the repo. LAF is what? LAF is the repo which is provided by RBI. LAF repo is provided by RBI to banks. So it is the deal that happens between banks and RBI. Okay, and RBI conducts auction for them. They are no more daily repo kind of a thing. But apart from LAF repo, we also have market repo, LTRO, TLTRO, TREPs, and CB repo, which is what you have seen in the previous slide, right? So so let us move further now. those repos that you saw were more from the market's perspective, in the sense that these are the products which are available in India to do repo transaction. But by nature, repos are of four types: buy sell repo, classic repo, tri-party repo, and then you have classic lending and borrowing, which is also there. So what are these repos? How are they different from previous repos that we discussed? Let us see here. Okay, so under a buy sell repo, that the lender actually takes possession of the collateral. Now this is very important point to be noted. Okay, so in a buy sell repo, the security is sold first. So if you are a borrower, you will sell the security to the lender, and lender will be owner of the security, but there is an agreement whereby you will buy it back after certain days. So same thing has been mentioned here. Here a security is sold outright and bought back simultaneously for settlement at a later date. That is what has been mentioned. Okay, and in a buy sell repo, the ownership is passed on to the buyer, and hence he retains the coupon interest on the bonds. So effectively, when you become the owner of a security, you will get all the benefits that those security give. And what do we get on a bond? We just get a coupon, right? The forward price of the bond is set in advance at a level which is different from the spot clean price by actually adjusting the difference between repo interest and coupon earned on the security. This is something which we had discussed earlier also, and I showed you the calculation also, which had two components in the previous slide, right? Now, apart from buy sell repo, we also have a classic repo. What is a classic repo? It is an initial sale of security with simultaneously, an agreement to repurchase it. What will happen in case of a classic repo? In case of this repo, the start and end price of the securities are same. So in a buy sell repo, the start and end price is different, but in case of classic repo, they are same. Only the interest is exchanged. Okay. And in classic repo, it's very clear that security is only for the purpose of collateral. There is no other purpose. Please remember. In case of a buy sell repo, the security is being sold, right? But in case of a classic repo, security is just being used as a collateral. That is the difference. And another difference that you have is that only interest component is exchanged. Price is not changed here. Then you can also have borrowing and lending transaction. Okay, the customer lends the bond at an open-ended or fixed period in return for a fee. So this is like you are lending a security and earning a fee. The fee charge would depend upon the type of underlying instrument, size and term of the loan, and credit rating of the counterparty. So I am a lender and I am going to give the security and get the money in lieu of that, and borrower wants the security, right? So borrower would like the money. Okay, so borrower has the security, so borrower uses the security for the purpose of transaction. Small correction here, right? So what will happen? The transaction would be taken care of by an agreement on securities, lending and cash or other securities of equal value, which could be provided as a collateral in this transaction. So in bond, lending and borrowing transaction, you are using bond as a collateral for borrowing money from the market. That has to be given as a collateral, and that will be used for the purpose of taking money from repo transaction. The fee charged is something that a borrower will pay to the lender, and it depends upon couple of factors, which is the instrument, size and term of loan, and credit rating of the counterparty. There can also be a tri-party repo in which there are three parties. Okay, and there's a custodian. Okay, so custodian could be any entity which is authorized by the regulator. For example, in this case, the tri-party agent in Indian market is CCIL. So CCIL takes care of the tri-party transactions as the third party. So under a tri-party repo, a common custodian clearing agency arranges for custody, clearing and settlement of repo transactions. So you have brought in a third player, which was not there earlier, but here you have a third player, which is the tri-party agent. Tri-party agent must be authorized by the RBI. So in this video, we have touched upon three things. One, what is the meaning of call term and notice? What is certificate of deposit? And what are the different types of repos? I hope this has been useful for you. This video would have been very lengthy if I had covered all the concepts, but I've just kept it restricted to three concepts. I hope they were useful. Please do write your comment in the comment section, like and subscribe. like the video and subscribe to this channel. Thank you.